Over the past 2 years, the Jackson Hole Symposium has been one of the most volatile events for markets, and it seems like it could be again in 2024. Why is this? Well, it's all got to do with overbought markets. We cautioned about this level being a key zone for the S&P, and so far we've seen some selling that may actually confirm a little bit of a change in sentiment over recent days. Huge dark pool activity, options flow, and of course, other opportunities on the markets. Today, let's cover stocks, commodities, and cryptos together. It's going to be a good one. Well, welcome back everyone to the Daily Show. I want to get straight into the sentiment reports because, of course, there is a bit to discuss here ahead of the Jackson Hole speech by Jerome Powell. But as we know, sentiment reports can tell us a lot about whether a market is overly extended towards the upside or the downside. Remember, everyone went bearish a few weeks ago. We obviously had to resume the bullish trend because we felt like it was a great level. But we also got some overbought signals. They came in over the last couple of days, and the market's been doing a little bit of this, and now a small sell-off has started. Will it get worse? Well, let's look at these reports and really break it down together properly. 51.6% of respondents this week were bullish and only 23.7% were bearish. Of course, that's under historical standards from the bear side, and it brings our bull-bear spread up big time, almost all the way back to the topping areas of market peaks. And this is not really something you want to see if you're a bull in markets right now, because it can state that there is a little bit of a pullback to occur to really get this back into uniformity. Now, if you have been worrying or wondering about sentiment spreads, remember the best thing is to actually have a net bullish read, but you don't want it too high and you want it to be kind of in the middle. I'll get an update on this chart moving forward into our weekend video, so make sure to subscribe for that. But you'll notice here that when we're in this kind of trapped area between 20% and 40%, it's actually a pretty good time to be a net bull in markets and to be looking for the buy the dip. It's actually an excellent chart. I'd highly recommend that you take a snapshot of it and keep it for the future. It's an amazing one. Let us know in the comments down below if you enjoy that as well. Now, the Jackson Hole Symposium, we know that it moves basis points in terms of the yields. Of course, what Jackson Hole is doing is they're having a good chat about everything, but really we're trying to figure out whether Jerome Powell is going to let anything out of the bag about rate cuts in September. And on top of this, what's going to happen with these Treasury positions that are really heavily levered? Well, it turns out that the Jackson Hole post-symposium has been actually quite volatile for the last 2 years, moving upwards of almost 3%, both in the positive way and the negative way back in 2022. So we can expect some volatility around the post of this particular speech, and just in general, the market's kind of getting a little bit more fragile in the time of year. But we do need to remember that we're still in a buyback period. That means that stocks are putting in around $5 billion a day in overall purchasing. The CTAs have been left behind. So that's, of course, the momentum funds, which still need to buy up positions. And many people were caught off guard during that VIX 65 event, which looked like the cataclysm. But of course, on this channel, we didn't think it was during that time. So let's talk about the amount of Treasury futures risk held. Now, a lot of people were confused by this chart, but it is pretty shocking. When you think about it, this is not only the largest amount of leverage positions ever in the Treasury's position, but it keeps getting bigger and bigger and bigger. I just want to read out some numbers here. Nearly 23 million contracts for the 10-year note futures equivalent are now outstanding. This peak means around $1.5 billion is at risk for every 0.01%, that's 1 basis point, move in the underlying Treasury notes. So basically the Treasuries are a really big issue in terms of leverage. Everyone is betting on rate cuts. And this could have these profound volatile events where it can move up and down as people get kind of pushed during the next couple of months. So I think Treasuries will need to be watched very closely. Now, a lot of you wanted to know, what do I think of this? How does this impact us as traders? It's kind of like one of those ticking time bombs. When you think about it, we've talked a lot about the Japanese yen. We've spoken about it for over a year. And then just a few weeks ago, it became the problem. But you've got to remember, it took ages to become the problem. So while this is in plain sight, while this is definitely an issue that could create incredible volatility and probably won't end well, there'll be a volatile event on Treasuries, could be a great opportunity for us when it happens, yeah? We won't be able to really dissect that. Ultimately, I think you've got to look at it this way. Treasuries are still a pretty good asset. And going into what we believe is a late cycle, ultimately big funds will start accumulating them. Think about Warren Buffett. He's been buying treasuries quite a lot in recent months. And on top of that, he's been building a cash position. Now, Buffett's not known for exact timing, but what he is known is playing the long game. And of course, now that he's in his 90s, I'm sure he's not really playing the long game anymore, but he can't change who he is. He's a great investor and he does it. By the way, check out our link in the description down below. Go over to our X and watch the Cathie Wood versus Warren Buffett video for the last 3 years. Let's just say Cathie Wood sold her Zoom position and she sold it for a massive loss, and she's been doing pretty badly. But on top of all of this, remember, buy companies with big moats. This was actually something I learned from Buffett when I was very young in investing, and it has served me well. If you don't know what a moat is, maybe go look it up. But let's just say you want a lot of crocodiles, and you certainly want to defend your stocks and your positions. And in this case, Zoom sucked. Let's be real. All right, let's move over to the percentage of moves per month. So you'll notice here that there's some interesting charts going on around which month is going to be the worst. Now, a lot of people are pointing towards September. And of course, we've talked about September post what we're expecting a rate cut could bring in the negativity into early October, and then we might see a rip higher. Now, this still seems like one of the most likely scenarios. So how much lower could we go right now? Well, a lot of people are calling recession. Remember, we don't have enough percentage points of not only this chart, but also I don't have it with my own reads, and I'll share them with you if I do see it for a recession right now. I do think one will come, but we have to celebrate the soft landing first. We have to celebrate cutting rates and everyone going, oh, look at this, we fixed the system, it's fantastic, everything's fantastic. And my belief it'll happen after that. Also keep in mind the thrusts that we saw in terms of technology stocks do tend to have pretty good reads when it comes to what happens moving forward. There are also a lot of reads about the 8 streak we saw. Remember, both the S&P 500 and the NASDAQ were up 8 days in a row. This does correlate with generally pretty good bullish sentiment. We have a lot of different data reads on this. This is 11 consecutive higher lows, which I believe we've now broken. So this is what kind of happens around those periods. And remember, the stats are that the mean return will be positive 2.37%, 84.21% of the time. And that's over, I think, the next 21 days. So this one here from Optima, go check them out on X as well, good guys here in Australia. And basically they have, as you can see, a very, very good read on the data and what's happening. This one here from Grant Hawkridge also shows something quite similar when it comes to the forward returns. And the biggest problem is the next 5 days. Now, we responded to this. This was about 2 days ago. So when you think about this pullback, this sideways action on the market to slightly down, yeah, it makes sense to the stats. Less than a coin flip at the time are we bullish after that point. Now, there are some other interesting charts, and Grant Hawkridge's got this chart as well, which basically shows here the highest amount or the percentage of stocks above the S&P 500. So basically what we're looking here is that how many stocks are actually showing extreme strength. And what you'll notice is a lot of the big peaking periods, we tend to actually be able to go even higher. So we could go to maybe 2018, we could go to even higher events overall. So you might think the top is in for now. I would say the top is probably not in on markets. And that's because when you look underneath the S&P 1500, 2000, 3000 stocks, you really look through them. Have a look at these percentage of stocks above their 10-day. Have a look at the percentage of stocks above their 20-day and even 50-day. Now, where are some of the good sectors? One of them in particular is real estate. Yeah, that's weird. To see real estate doing so well is not a symptom of a dying economy just yet. That is actually a pretty strong read. Now, we also have utilities doing very well, which does bring a smile to my face. I'm sure a few of you out there, because I do believe that this is late cycle style investing. Utilities is a really well-known concept that most people overlook during these times. And we've also got weakness in energy. And you might say, well, is that normal? It kind of is if we are expecting a rate cut. Energy is quite susceptible to rate cuts in particular. It's something we'll look at in a moment. Earnings estimates continue to get upgraded. We cannot overlook this. What the street wants, ultimately, they are going to go for. Remember, what they're doing is they're revising down, and then they're still revising, kind of up in certain stocks as well to keep it so that they can always keep beating the expectations. And there's all sorts of games going on from Wall Street from that aspect. But this is probably still one of the most important charts over the next 3 months. And guys, this has to do with whether we're going into a recession or not. Let's not leave it up to our limited amount of data that we're getting. Let's actually let the market structure up. So remember to follow the channel, because over the next 3 months, we're going to work out whether we're in this kind of one or whether we're in this kind of one. And remember, if we are going into a recession, generally it is a slow grind down. The Federal Reserve also might show us this by if they cut a 50 basis point. Now, I don't believe they should. People a few weeks ago thought 75 basis points. That was absolutely mental. That was basically showing that we were in a full-on blown crisis. Everything was blowing up. But the speed at which the Fed cuts will tell us whether we're more the late cycle aspects, like these ones here, or we're in the thick of it and they completely stuffed it up. Remember, there's no harm in saying that you might believe that there is a recession coming, but timing will be everything. Let's take a look at the gold bull analog as well. You know I'm a big gold fan. A few of you guys are. I do suspect that it might have a little bit of a pullback here if we get into some volatility. But in general, have a look where we are right now and have a look if we run like gold often has. Could we go to 7,200? Now, that's a big call. I've talked about 3,000. I even think 3,600 is very, very achievable over the next coming years. But realistically, you've got to remember, this is actually a point where many of these gold runs have actually had a nice little uptick, then they've gone sideways, then they've upticked, and it's expected that maybe by mid-2025, we might be at that $3,000 mark. What do you think? Let us know in the comments down below. Wayne Whaley's data here, when we have a great start to the year, when we have a bad 2 weeks in August, how does it look? Turns out we've got a lot of reads. That's always good when we have a bunch of data. And it tends to mean that the back of September to early October is where the biggest weakness is. Now, that's post what we expect to be a rate cut. And if we looked at that chart before, we know that rate cuts over the first month often bring weakness to the market. Now, this is, I think, where people are going to get really confused, because remember, rate cuts are bad for the market. It means that there is a weakening of the economy. In this case, they're trying to engineer the soft landing, which we all know they'll fail at. But ultimately, they need to look like they're doing it first. So it will take a bit of time to happen through. That will be a very interesting chart to watch. Let's talk semiconductors. We spoke in our last video about the idea that there are semiconductor bears coming in. Well, these bears are sneaky, dark pool, nasty people, because they did push the market down over the last 24 hours, and they did it with some nice 3x leveraged funds. We also saw the ProShares Ultra Triple Q get a trade on it. And yeah, well, it turns out they're probably doing a little bit of take profits as well. Have a look how good these levels have been as well. Beautiful levels over here. Oh, so great. Look at us go up. And then we saw a pullback, and then we saw them kind of buy a little early. I don't blame them. I know why they bought there, because of course that was a pretty good solid level. Great structure zone, great volume profile, great moving average levels as well. They dropped a little bit more, but ultimately they made some good money. And of course, now they're looking at selling right where that gap is. At least that's what we assume they're doing. Now, we obviously are making assumptions here, but they are pretty good at getting turning points. And that doesn't mean the market's going to crash and go to new lows or anything. We're not sure about that. Another one was the Russell 2000. We saw this over the last session. I just want to kind of show you the price action after that. Remember, it's not insta sell. Have a look at how nasty this price action is. Takes a high a couple of times here, takes out people that are probably trying to short it, and then decides to go, oh, okay, we're going to go negative now. It's pretty classic, and as you guys would know, this is the type of thing we look for. Let's go over to sector rotations. In general, semis were down. It was risk off across the board. We saw all tech, we saw semis, we saw solar, clean energy, consumer discretionary. All of these kind of markets were down on the session, and that takes us to a 5-day run now where semis are actually down. So what that is that's consolidation. So basically, we had that beautiful run, semis, NVDA, we love that thing, plus 30%, amazing stuff off the lows. And then we've got all these defensive positions coming through. So we've got gold kind of doing well, that's good. We've got home builders doing well. Again, this is not symptomatic of a sustained crash. Regional banks are one of the best 5-day returns. That's pretty strange. Like, you don't usually see that when you're going into a full-blown recession or anything. Let's now move over to the S&P. So we know that we got some signs of overbought. Some people want to have, they were wondering what this is in the comments. It is part of our advanced masterclass course and mentoring. So if you're interested, you can always get it from there, along with some amazing cyclical stuff and, of course, our data, seasonal approach, and, of course, TA approach. But have a look here at the overall kind of advanced decline line. I always suggest you should have a chart with this on it so you can see kind of how it's going. It's still going well, but it was dropping a little bit over the last 24 hours. To be, kind of considered, and also to be considered are these two gap fills. It would make sense to get the market down to one of these levels. But I do think that there'll be bulls at these zones because remember, we didn't get the thrust like we did for no reason. People want to be in this market, whether that is a false market rally or whatever, they do want to be in it. And of course, Wall Street keep upgrading the numbers and they're going to use that as their forward guidance when they go to their clients and say, we believe that the markets are, growing and everything like that. The GDP is increasing. We want to buy in. So they are buying. That's just how it is. And we're in a buyback period. Remember this. So US 500 did break structure first time. We've spoken about the 2-hour 20 moving average. Remember the 20 is great. The 1-2 system is fantastic as well. I'm going to just tell you what the 1-2 system is. Basically, if you're seeing a series of higher highs or lower lows, once you see 1, once you see 2, the 3rd, the 4th, the 5th, the 6th, the 7th, the 8th, the 9th, as long as it keeps making higher highs, and then it breaks at the 10th. But this is a great run. Now, once you define the 20 moving average or the moving average on any of these particular stocks or indices, you'll find that they do usually have a 3rd and a 4th, and they can pay out quite nicely. Very difficult to get into this trend otherwise. So the 1-2 system, therefore the 3, 4, 5, 6, 7, 8, 9, all the way to the 10, were all excellent buys. And if you'd been doing that, you would have had a good time. But that's broken because, of course, we made it underneath the 20, which means that as it comes back up, which will just kind of get the price here, around 5,600, interesting number, we may see some resistance around here because we know that we've also taken out these lows. So we've gone from higher highs to higher lows to a lower low, and we're starting to break structure. So it opens up those two gaps. There's certainly things that we need to be watching here post Jackson Hole, post, of course, or next week, we need to be looking at them, but it can bring us a little bit of a sell. Now, if you're in it for the long haul, if you're in it for like, a couple of months here, if you're in it for, a year or so, do you really need to be concerned about this? A lot of people think they're going to like up and down and minutiae of the market or whatever. It's not really concerning. Don't worry about too much. This is only a very small structure break. Is it a daily break? No. Is it a weekly break of structure? Absolutely not. We're still heavily in an upward trend. But that's the first sign this entire way up, and we've been looking for it. That's the first sign of weakness, guys, that we have seen the entire way up in this rally. S&P 500 also changed when it came to options. We talked about 56.30. That was a huge call strike that everyone lost on over the last 24 hours. Now we're sitting around 5,600. You'll notice here, look at this 5,600. There's calls all over this thing, everywhere calls. We are in a mixture of kind of neutrality here between negative gamma and positive gamma. If we get through 55.45, that could start to expand the sell downside and create waterfalls. And you'll notice there's a lot of puts that just appeared over the last 24 hours in a lot of these markets. So something to keep an eye on. We're trapped in a tight zone here, but I think price action along with the options is going to show us stuff. NASDAQ CTAs still floating around nowhere land. SPX, so the S&P's same thing. Silver, neutral, I would say. And gold CTA is actually negative now. So the price action is not agreeing with the CTAs. Now that is a worry, but I would always take price action over CTAs. I'd certainly be cautious here, and we'd look for gold pullbacks a little bit more. NVIDIA, we knew that 130 was a call wall. Where is the put wall? Well, it's probably more like 120. So there's still more downside potential here for NVIDIA, but that call wall was too much. And that's because it's just too much money to pay out. That's a clear call wall being such a huge amount of lines compared to everything else. Tesla, very terrible. Like you've got to say, Tesla should have made it to 232. The stock really has some negative sentiment on it, you can tell. But 210 is a big level for the puts. So if the market's going to hold up, it's kind of got to hold, around this area. Let's see a bounce off 210, move up a little bit here on Tesla. Difficult to read this stock at the moment because, of course, we've been looking for 232, 228, and the market's been grinding up, but it's just not that strong, is it, when you look at it on the charts? Let's move over to the charts. US 2 versus 10, not much change here. Of course, we are looking at what happens to the 2-year and the 1-year yields. We're also interested in Treasuries. Now, remember, this is the one that the leverage is all over. So it's been acting strangely. yields have gone up actually recently, yet treasuries have also gone up. People are placing monster bull bets. And I don't know how it's going to play exactly. No one really does. But I would be very cautious against being levered in the wrong way or anything like that on treasuries, because it seems like there is a ticking kind of a volatility bomb here, and we must be aware of that. Now, I think it'll bring opportunity, so it brings up that patience, react, don't predict. If you're going to hold treasuries for a long time, maybe it's still damn good. But if you're going to be looking for opportunity, there could be one coming on the horizon in treasuries. What do you think in the comments down below? Dollar index was up, no surprise. Beautiful hit of target this week, guys. Great work on currency trading. And we're looking for the market back to the 20 moving average. So this is the area. This is what we're looking for. Hopefully we can get there. Copper, just at the resistance. Nothing in terms of breakout. We'll watch that soon. Gold pulling back. Can it get to 24.50? This is a good level to be looking on the small time frames for potential trades to the upside. It did break out, of course, last week, and technically it's in a negative structure now. So if gold does rally somewhere into the 25 kind of 10 area, 25.05, that's where I'd expect sellers to try to press it down to 24.50. So first time it's actually looked weak on the charts for a while. Silver, again, I don't mind a pullback here. I'm very bullish on silver. You guys know this. I like the ratio. I think silver's better than gold in terms of pure ratio as of now. Obviously, gold is the way better investment asset class. But you can see here that silver broke through nicely. It is downgrading itself a little bit at the moment. It'd be interesting to see how the weekly ends up. But we'll be watching 20 daily moving average, something to watch. You've seen it's respected that a few times around this point. And of course, if we do get deeper pullbacks, there could be a good opportunity on the long side. UK oil, US oil, they all hit these kind of critical supports. They did bounce. I got to say, I wasn't heavy on that bounce. It's a very, very tough position here for oil because it keeps pressing this low, and that has me a bit worried. I think this is where bears still sit. We don't go above 74.20, and if we don't do that, then we're not really looking at bullish sentiment. So generally speaking, we're at a demand zone, we're at the support, but we're not seeing heavy buying just yet. And CTAs, they're kind of like neutral all over the place. Tesla, as we said, 210s where the put wall is. This is the real res at about 232. Where's the buyers? 210 could be it, but probably more likely around 200. So we'll see whether Tesla keeps moving down. NVIDIA, no surprise that 130 was sold. I'd like to see further action towards the downside just to kind of get it into more uniformity. This has been a great run. Don't get me wrong, I still bullish NVIDIA and we're liking it. But at the same time, this is what semis have to do. They've got to get a little bit off because people were just clamoring for the calls. You saw the meme today. They're clamoring for the calls at the wrong price and they're getting owned for it. Intel gave up the ghost. So, of course, we had that this week. Had a buy around here, stop loss, or in this case, it was pretty much entry. The entry was broken even. That's sometimes how it goes. You've got to remember that the market actually did dump pretty hard in terms of a lot of these types of stocks. So that's what does happen sometimes. We had a win on Crowd. We had a win on several other positions, including SMCI. They're actually all very similar positions, but Intel just wasn't able to do it. It was up about 4 or 5% at its peak, but you've got to get your ratios right. So in this case, it's just an entry break even is what it is. Just thought I'd update. HSI, beautiful stuff in China in terms of stock market move action, price action holding up well against the US. And you'll notice here we put in a nice green daily. So it does look like this is turning around. Some people have been going towards JD. Of course, Walmart selling their stake in it. Interesting little level, ended up with a bull kind of holding around. It's actually not a bad zone for JD. I'm not sure if it's a great position or not. I like to buy an idea rather than one stock. But remember, we have been looking a lot at Tencent as well. US 30, the Dow, also giving us kind of signs of correction or like little turnaround or like pull kind of area. So this is all that area where you've just got to be a little bit cautious. It can create a lot of chop. Like you'll notice when you get these types of signs, you either get pullbacks or you get like a lot of chop in markets. So remember, a pit or a pullback in time, which is just this, there's nothing wrong with that. So we like pits and it's fine. If it does that, that's just what it's going to be. US 2K, we saw some big dark pool trades. Still looking for this to 2250, but ultimately if it pulls back, 2080 is the key level to watch. And what about the Qs? Well, the Qs gap filled. Why can't we gap fill on the bottom end? I'd like to see these prices start to come in. So I'm marking them out. I know a few of you watch in the car. Hello to anyone that's watching in the car. Make sure you look on eyes on the road, guys. 462, 451. They're the two main levels for the Qs. And of course, you can extrapolate them out to NQ and US 100 codes. BTC. Now, this has been a lot better. Great daily close, previous session to today. And then when we take a look at this, you can see if it can breach through 62, then we're looking at 65 min or 68. And I actually quite like the Bitcoin chart at the moment. I'd like to see it hold up. Can it do it in the face of a potential sell in the markets? I guess it could. It's totally behind things like the Nasdaq, the semiconductors, these kinds of markets. And Ethereum is doing nothing. So Ethereum is still coiling. Remember, the longer something coils, the more explosive the move tends to be. So there's nothing wrong with the coiling market. We're still looking towards more upside than downside here. We'll see whether it comes through. Jackson Hole Symposium, that's coming. Keep an eye on the charts. Now, sometimes Jackson Hole Symposium, when you get Fed Chair Powell speaking, sometimes he speaks for like 5 minutes. So I don't know how much it's really going to move the markets, but what we do know is it could be used as an excuse, as a catalyst to make markets move. So 10 a.m. in New York, that's when he is talking, and I'm sure that will be a boring speech. Anyway, if you enjoyed today's video, make sure to follow us along on X, and of course, check out some of our other stuff if you're interested. Links in the pinned comment down below. And also, if you're interested in finding out more about cyclical theory, some of the things we've talked about today, check out our day trading masterclass and our advanced masterclass and mentoring course. Be great to see you in there, guys. But either way, you have a fantastic day, and let's see what Jerome Powell's got in store. Bye for now.